So I want us to go through capital structure theories. It has two parts. The part one are the traditional theories of capital structure, and there is part two, which is the Modiglian and Miller's arguments. So I want today to introduce part one. Part one of this subtopic, that is the traditional theories of capital structure. You remember last time, when I was introducing this topic, I did mention capital structure, and I said that a capital structure is defined as the mix of the various long-term funds employed by a firm, combination of the various long-term funds employed by a firm in financing their assets. Now, this mix comprises of equity capital, debenture capital, and preference share capital. So capital structure is the mix of those three: equity capital, debenture capital, and preference share capital. And it's important for you to appreciate that equity is made up of ordinary share capital and reserves. That is equity. So ordinary share capital, reserves, debenture capital, and preference share capital is capital structure. That mix is what we refer to as capital structure. Why do we make a capital structure decision? That is one question that we need to ask ourselves. Is for purposes of establishing whether an optimal capital structure exists. The prime objective of making a capital structure decision is to find out whether an optimal capital structure exists or not. Now, that's an area where various scholars in finance don't agree. Those who support the argument that a capital structure decision, an optimal capital structure decision, those who do not agree with that argument. Some scholars support the argument that an optimal capital structure exists. Now, those ones who argue that an optimal capital structure does not exist. So the question we ask ourselves, does this optimal capital structure really exist? Now, that's an area that most scholars in finance do not agree. It's an area that most scholars in finance do not agree. Some argue an optimal capital structure exists. Some argue it does not exist. Now, those who support the argument that an optimal capital structure exists argue that an optimal capital structure is one that will maximize value, while at the same time minimizing cost of capital. In other words, the argument is that firms which have an optimal capital structure tend to maximize their value, while at the same time minimizing their cost of capital. And when I talk about cost of capital, in this case, I'm referring to the weighted average cost of capital. In this context, I'm referring to the weighted average cost of capital. So if a firm has an optimal capital structure, then that firm could maximize its value, while at the same time minimizing its weighted average cost of capital. Please take note that that is a very, very important. That is a very, very important proposition. That is a very, very, very important proposition. Please take note of that, ladies and gentlemen. I'm saying that the argument by some scholars is that if a firm has an optimal capital structure, then that firm tends to maximize its value, while at the same time minimizing their weighted average cost of capital. Okay? Now, that's a proposition that, by scholars who tends to agree with the proposition that an optimal capital structure exists. But remember, I told you, this is a controversial question because some scholars in finance agree with that proposition and some scholars disagree. So those who agree with the proposition that an optimal capital structure exists believe that firms which have an optimal capital structure tends to maximize the value or minimize their overall cost of capital. But those who argue that an optimal capital structure does not exist, those also who believe so, that an optimal capital structure does not exist. In other words, a capital structure decision does not matter. Believe that a capital structure decision has no effect on value of the firm, has no effect on the firm's cost of capital. You can see that these are now these are conflicting opinions. Some scholars arguing capital structure decision is irrelevant and can affect value and the cost of capital. And some other scholars arguing that a capital structure decision is irrelevant and therefore it has no effect on value of the firm and no effect on cost of capital. Now, these contradicting views are contradicting views by scholars in finance. And these views have been expressed in what we refer to as capital structure theories. These various views of scholars have been expressed in what we refer to as the capital structure theories. So the existence of an optimal capital structure is not known. The existence of an optimal capital structure is a subject that is not really guaranteed because of the various diverse opinions of scholars in the area of finance. So, ladies and gentlemen, that is the basis, and hence capital structure theories, and hence the capital structure theories. Now, these capital structure theories are classified. These capital structure theories can be classified into three. I've already shared with you the notes, which you already have, but I want to believe you guys have seen that we have the first category of theories we call traditional theories. Of capital structure. Number two, we have the Modigilian and the Miller's arguments. Modigilian and the Miller's propositions. Now, by the way, when you look at the first category, traditional theories, we have two theories in this class. One is the net income theory. And number two is the net operating income theory. So the traditional theories of capital structure are classified into two. One is the net income theory, and the other one is the net operating income theory. The Modigilian and Miller's propositions, these are propositions by renowned scholars in finance, known as Franco Modigilian and Morton Miller. Franco Modigilian and Morton Miller. The Modigilian and Miller's propositions are propositions by Franco Modigilian and Morton Miller. Franco Modigilian and Morton Miller. In short, the theory is known as Modigilian and Miller. We like more often calling MM's theories. MM's theories. First theory, the first M represents Modigilian, the other theory, the other M stands for Miller. Now, Franco Modigilian and Morton Miller kept on improving their propositions. The first proposition in the year 1958 was referred to as MM1. MM1 of the year 1958, MM without access. I'm giving a general view of these subtopics so that before we start unpacking on the specific one that I want to talk about today. MM1 of the year 1958, MM without access. That was the first proposition. And let's not forget the background I've said about capital structure theories, what scholars believe. I've already told you that those who believe a capital structure decision is irrelevant and affect value and cost of capital. But those who believe a capital structure decision is irrelevant will have no effect on value and the cost of capital. Even Franco Modigliani kept on changing his arguments. Franco Modigliani and Merton Miller kept on changing their arguments. Their first theory of the year 1958 was MM without access. Now, I'll talk about it at the appropriate time. Their second proposition, MM2, of the year 1963, was MM with corporation taxes. So Franco Modigliani and Merton Miller incorporated corporation taxes in the model. So you need to MM with corporation taxes. Of course, the argument changed. The argument of Franco Modigliani and Merton Miller, MM without taxes, was different. When they brought in corporation taxes, the argument changed. The third theory, MM3 of the year 1977, this was MM with taxes, with corporation, MM with corporation and personal tax rates. MM with corporation and personal tax rates. So Franco Modigliani and Merton Miller in the year 1977 introduced personal tax rates in their model. So that theory in the year 1977 was referred to as MM with corporation and personal tax rate. Their final model, MM4 of the year 1984, that was a final model, MM with taxes, both personal and corporation taxes, and financial distress costs. Financial distress costs. Have you guys seen all these in the handout that I've given you?
Yes.
Taxes and financial distress costs. Have you seen all these propositions? If there is a topic that I've done very well in my proposed book that I'm doing, is this topic. If there's a topic that I took a lot of time doing, is this topic. And you notice that under each of these, I was able to explain and bring an illustration. In fact, even if I don't teach you, you guys can go to those notes and read. They're self-explanatory. These notes are I try to make them as simple as possible. As simple as possible, using the most simplified language. These propositions, I've explained them very well. And by the way, even from the exam perspective, this is an area you have to be very, very careful. I've seen this area in exams every time. These theories, they're there every time. Even last sitting, I think, something. So you cannot tell whether it's MM1 or MM2 or MM3 or MM4. Examiners can go anywhere. But what I know, it's a fertile area in exams. Now, the final category of theories are other theories of capital structure. So I started by talking about traditional theories, Modigliani and Miller's proposition, and 3 other theories of capital structure. Number 3, other theories of capital structure. Other theories. Umeona kwa notes? Anybody who has seen those other theories? By any chance? The other theories.
Order. Pecking order and
Pecking order.
Pecking order theory.
Trade-off theory.
And the trade-off theory. But these are the only ones. The market timing. You see a handout. You can slot it somewhere. The market timing theory. Just remember this. I think I'll slot it also into my book and talk about it. Pecking order, trade-off, and there's the market timing. The market timing, I think I'll bring it in. I doubt. Or did I mention about it in the handout here? Not sure, but I did talk about it. It's a pecking order theory, the trade-off theory, and there is what we refer to as the market timing theory. So this is the scope of this second subtopic, the capital structure theories. But of course, we need to start by going through the traditional theories. Once you understand the traditional theories, then we can pick on the Franco-Modigilian and Miller's propositions, MM1, 2, 3, and 4. Those other theories, I'm sure you are capable of reading on your own on that. Okay, now, before I share my document, before I share the document on the net income theories, there are certain generalized things that I want to discuss before I move to my handout. Kama naweza tafuta ile board kubwa. Tu muda kidogo Let me look for some board. Kuna ile board kubwa kidogo kama naweza ipata. Dakika moja tu, mabundles zimeanza kuisha. Inakuanga shida hii online teaching, unless kuna wifi kwa nyumba, kuna kuanga na challenges kidogo That is one of the challenges with this online teaching, but it's nothing that can be done really. So for now, we must bear with that. Ndio. Wenzangu Are you able to see my board? Hii board kubwa. I want to delete this information here. Where do I go? Let me see. Are you able to see something?
Yes. Yes, you can see it.
Unaona hiyo board
Yeah.
Ngoja nione if I can delete this information. I have a lot of information here. Hii board yaishangi. It's a very big board. Clear. Fikiri ni hii sawa, nimetoa. Now, so this one is about yaishangi. Inaweza andika, hata sijui nilisahau aje ningeanzia kuandika. Kwa hivyo, I've given a background of those theories, traditional theories, the Modigilian and Miller's argument, and we have the other theories of capital structure. Let me introduce the first category of theories we call traditional theories. Now, one thing that should be very clear at the back of your mind, ladies and gentlemen, one thing that must be very clear is what are these capital structure theories say? I've already told you that those scholars who believe a capital structure decision is irrelevant. There are those who believe it's irrelevant, and I've explained the basis. Okay, now, one of these theories in this class, net income theory, is a capital structure relevance theory. One of the traditional theories is net income. The net income theory is a capital structure relevance theory. Then the net operating income theory is a capital structure irrelevance theory. I think I've already told you that when we say a theory is a capital structure relevance, what the theory says is the capital structure change or a capital structure decision will impact on value and the cost of capital, will affect value and the cost of capital. This is what the net income theory says. A capital structure decision will affect the firm's value, will affect cost of capital. Net operating income theory is capital structure irrelevance. A capital structure decision will have no effect on value of the firm and will have no effect on the firm's overall cost of capital. Now, before I talk about the specifics of these theories, let me say that traditional theories of capital structure are based on certain assumptions. Anybody who can see the assumptions I've listed in the handouts? There are certain assumptions of these theories. Number one, it's assumed there are no taxes. It's assumed there are no taxes. Number two, it's assumed there are only two types of long-term capital, debt and equity. It's assumed in the firm's capital structure, there are only two types of long-term capital, debt and equity. Number three, it's assumed that a firm will remain a going concern. A firm will remain a going concern. That means there are no going concern problems. We are assuming there are no going concern problems. A firm will continue operating each year, indefinitely. That the firm's going concern is not doubtful. There are also other assumptions. There are also other assumptions of these theories, like the assumption that markets, perfect capital markets exists. The assumption that a firm adopts 100% payout ratio as it is dividend policy. It's assumed that a firm adopts 100% payout ratio as its dividend policy. That is, all earnings attributable to the shareholders are shared as dividends. 100% payout means all earnings attributable to the shareholders are paid as dividends. It's assumed that the firm will generate. It's assumed a firm will generate equal operating income each year. Operating income in this case is earnings before deducting interest and tax. It's assumed that each year the firm will generate the same operating profit. Year 1, year 2, year 3, year 4, up to infinity. It's assumed that the investors' expectations about the firm's EBIT is homogeneous. Investors' expectations about the firm's operating income is homogeneous, similar and identical in all respects. These are tumeziona hizo assumptions kwa handout. Yeah, so these are assumptions which we have to have at the back of our mind. Assumptions upon which these theories of capital structure are based. Now, that's the first thing. But one thing you can see is that these assumptions are not realistic. No taxes. Taxes are there. That a firm has two types of long-term capital, debt and equity. That's not realistic. that there are no going concern problems. Going concern problems can be there, that all earnings attributable to shareholders are given out as dividends. That is not realistic. That a farm will generate the same operating profit every year. Not really realistic. So these assumptions are assumptions which obviously are unrealistic and hence shortcomings. Now, for purposes of justifying the propositions of the theories, the net income theory and the net operating income theory, we need to come up with a few formulas. If you check in my handout, I've defined some formulas. I think I've defined S, I've defined B, I've defined KS, I've defined KD, I've defined EBIT, and I've defined interest. Yes, I've defined these elements, the handout that you have. S imeita market value of equity. Or ordinary shares. Market value means market price. Market value means market price. B is market value of debt. The market value or market price of debt. By the way, there's B also. So S is market value of equity. B is market value of debt. KS is cost of equity. The cost of equity, or in KD, hakuna taxes. KD is the cost of debt. Sorry, it's not KDT because there are no taxes. KD is cost of debt. EBIT is operating profit. Operating profit. I is interest, of course, on the debenture. V is S plus B, market value of the farm. Total market value of the farm. Hiyo yote mmeona kwa handout? Je, hizo zote mmeona? Have you seen this in the handout that I've given to you? Ama hiyo handout nimepeana tu for fun? Handout imesoma kweli? Does not cost anything to respond. Does it really cost? Does it cost anything to respond?
They are there.
These variables, I've defined them there. Now, these variables, I have connected them into formulas, which are very, very useful. There are a few formulas we have come up with. One is the formula for establishing the current market value of equity. Tafadhali tuanze kukumbuka valuation models. Current market value of equity. What I've defined as S. Now, let's go back here. The assumptions of these theories. Look at assumption number 4. The firm will adopt 100% payout. Assumption number 4 says 100% payout as its dividend policy. If a firm adopts 100% payout as its dividend policy, it means all earnings are shared as dividends. All earnings are shared as dividends. And where that is the case, earning per share is equal to dividend per share. At 100% payout, all earnings are shared as dividends. Now, when you come to assumption number 5, it's assumed the firm will generate equal operating profit each year. Equal operating profit each year. Operating profit year 1 is equal to operating profit year 2. And this can go on up to operating profit infinity. If the firm has generated same operating profit each year, it means operating profit year 1 equal to operating profit year 2 equal to infinity. Now, this looks like an annuity. This operating income looks like an annuity. And by the way, even here, you could have said EPS year 1 equal to EPS year 2 shall equal to, this can go on up to EPS infinity. EPS year 1 equal to DPS year 2, and this can go on up to infinity. Another perpetual annuity. Yeah? When you look at the document I shared with you on valuation models, which model should be used in valuing ordinary shares under these circumstances? Anybody who can remember? I think I discussed this in class even. Which model should be used in valuing equity shares under that circumstance? Anybody who can remember?
Is it the Gordons?
The Gordons.
Capitalization?
Yes.
Is it capitalization?
Capitalization of earnings model. That's very, very correct. Very, very correct. Capitalization of earnings model. Where we said P naught is equal to what, Jackson? We said P naught is equal to what?
EPS. It is E over DPS.
DP or DPS divided by KS.
Yes, yeah.
Correct. Correct. Yeah, you need to recall your background of cost of capital and valuation models here for you to understand these theories. That's very, very correct. Now, this P naught is what I've defined as S. Now, P naught is the price of a share. Let me clarify. P naught is the price of a share. But S is the market price of all the shares. So that market price of all the shares shall equal to operating income divided by cost of equity. Now, I have talked about market value of the shares, not one share. S is the market value of all the shares. And by the way, this is one of the formulas which you guys can see in my handout. Operating income, of course, which is treated as a perpetual annuity. So if you want to know the market value of the ordinary shares, you'll take the operating income divided by, of course, minus interest. Sorry. Oh, sorry. Minus interest. Sorry for that. Because it is net income. Operating income minus interest divided by cost of equity. And remember, we have no taxes. Remember, we have no taxes. So the market value of equity shares is operating income minus interest. Now, that's the net income. Because we have no taxes, that is what is shared as dividends. So when you're looking for the market value of equity shares, you'll take operating income minus interest divided by the cost of equity. It therefore means that cost of equity shall equal to what? If you make KS the subject of the formula, the cost of equity should equal to operating income minus interest divided by market value of equity times 100. If you express cost of equity in terms of the rest, then the cost of equity is operating income minus interest divided by the market value of equity. It's what I've done here. You can say my KS is equal to DPS or EPS over P naught times 100. For any formula, you can make KC the subject of the formula, KS, which is DPS or EPS divided by PS times 100. So if you come down here, the same thing. I hope you have seen this in the handout. So formulas meziona hapo. Market value of
Yes.
equity, cost of equity. Now, the next thing, you'd say number one. Number two, how do we find the current market value? Current market value of irredeemable debt, redeemable debentures. Current market value of redeemable debentures, nimeita B. Which is a formula for valuing debentures which are irredeemable. The current market value of a debenture which is redeemable is equal to what? From our background of valuation models, you take interest divided by KD%. I hope you have seen this from our valuation models. Therefore, that is the market value of a unit. But now, since we have many units, those units are the ones I'm calling B. The market value of the units. These are units ndio hizi nimedefine hapa mwisho. Blackboard yangu ni kubwa. B. Market value of debentures. B. So LVD is the market value of a unit. So for many units, you'll take now total interest divided by KD%. Total interest. In interest on a unit, you discount to find market value of a unit. But the total market value of all the units is interest over KD. That means that KD should equal to I over B times 100. Again, if you express KD in terms of the rest, and KD is total interest over total market value times 100. Finally, is finding the weighted average cost of capital of a levered farm. Remember, from our assumption here, from this assumption here, assumption number one, assumption number two. Assumption number two, we assume there are only two types of long-term capital, that is debt and equity. That is assumption. There are no taxes. Let's not forget that. So when you come here, what are you saying there? Weighted average cost of capital is cost of equity times S over V plus cost of debt, B over V. There are only two types of long-term capital, debt and equity. There are no taxes. Now remember, I said S is the market value of equity. V is S plus B, total market value of the farm. EV is S plus B, the total market value of the farm. So I think in short, weighted average cost of capital is equal to cost of equity times market value weight of equity plus cost of debt times market value weight of debt. From your background of cost of capital, you guys are aware that the weighted average cost of capital is an average cost of existing funds, more often than not determined using market value weights. So once you find the market value of ordinary shares divided by the total market value of the firm, where the total market value of the firm, in this case, is market value of equity plus market value of debt. So market value of equity divided by the total market value of the firm is the market value weight of equity. The market value of debt divided by the total market value of the firm, the market value weight of debt. WS is market value weight of equity. Market value weight of equity. Hiyo mnakumbuka? Toka your section 3 work.
Yes.
Market value weight of debt. So we are back there to your section 3. Weighted average cost of capital is determined using market values as weights, unless otherwise stated. So cost of equity times market value weight of equity, cost of debt times market value weight of debt. Finally, value of the firm is market value of equity plus market value of debt. I think I should have started with that. The total market value of the firm is market value of equity plus market value of debt. So as a V market value of equity, we said EBIT minus interest over the cost of equity. Plus market value of debt, I divided by the cost of debt. I think I should have begun from there, but all the same. That is it. You can find the market value of the firm in that manner. So market value of equity plus market value of debt is the total market value of the firm. Now, why are we interested with all these discussions? It's because we want to find out whether a capital structure decision will affect V and affect WACC. If a capital structure decision affects V and affect WACC, then we conclude that a capital structure decision is relevant. If a capital structure change or a capital structure decision impacts on V and impacts on WACC, then we conclude that a capital structure decision is relevant. And therefore, an optimal capital structure exists. Which capital structure will maximize V and minimize WACC? If a capital structure change will have no effect on V and no effect on WACC, then we conclude that a capital structure decision is irrelevant. And therefore, an optimal capital structure does not exist. Now, these stories are the stories which I think I had shared with you in this document of mine. For those of you who are keen in reading, I'm sure you have seen all these stories in, you have seen these stories here. I've already explained. And I went further here to talk about the traditional theories. Hizo stories zingine, hizo nimewapatia niliziweka. Sijui kama nili-explain mahali, but I think I explained them somewhere. Theories, capital structure, ndio hizo. I went direct to the formulas. But anyway, I've explained to you. Now, one of the propositions of capital structure is the net income theory. The net income theory is a capital structure relevance theory. The net income theory is a capital structure relevance theory. And because it is a capital structure relevance, this theory says that a capital structure decision or rather a capital structure change will have an effect on value of the firm and will have an effect on cost of capital. The marketing which we are forced to, me, I don't like this. I'm busy doing my work and people want to force me kuangalia vitu zao za marketing hapa. So net income theory is a capital structure relevance theory. The theory provides that a capital structure change will affect value and will affect cost of capital. A capital structure change will impact on V and WACC. But the most important proposition of this theory is that as a firm increases the amount of debt in the firm's capital structure, as a company increases the amount of debt in the firm's capital structure, the market value of the firm increases and weighted average cost of capital reduces. As a company increases the amount of debt in the firm's capital structure, the value of the firm increases and weighted average cost of capital reduces. But caution must be taken. As a firm increases the amount of debt in the firm's capital structure, caution must be taken not to increase the amount of debt to a level which is abnormal. The increase in the amount of debt should occur up to a point we refer to as optimal debt point, the optimal gearing level. Of course, you can increase that amount of debt, just like what the theory says. You add the amount of debt in the company's capital structure. And the theory believes as you do so, the value of the firm will go up and the weighted average cost of capital should come down. But caution must be taken not to increase the amount of debt beyond the optimal gearing. Now, other than those other assumptions I gave you of the net income theory, the net income theory is based on two other assumptions. One, that at all times, the cost of debt should be less than the cost of equity. And number two, you can see down here, the cost of debt should be less than the cost of equity. Number two, the cost of equity of a firm will remain constant. It's assumed that as a company adds the amount of debt in their capital structure, the cost of equity does not change. But I think that assumption is unrealistic because practically, if you add the amount of debt in the firm's capital structure, you'll expect that the risk exposure to shareholders will be higher. And therefore, you'll expect that shareholders will require compensation in terms of increased minimum required rate of return. So assuming that the cost of equity does not change is not realistic. I've given a small illustration here to prove that proposition, where I'm saying that ABC Limited generates operating income of 6 million each year. This is expected to remain constant each year in perpetuity. The firm has in issue 5% debenture that was issued to raise 5 million. Each unit of debenture is current trading at par. The cost of equity is 10% required. Determine the current market value of the firm, and it is weighted average cost of capital. Two, we compute the current market value of the firm and its weighted average cost of capital if the amount of debt in the capital structure is increased to A, 10 million, and B, 15 million. What is your observation? Okay, this is my suggested answer. So those formulas I've given you, this firm's okay. My suggested solution. How many debt levels? If you check the current debt level in ngapi? Now, bundles ikiisha, niambie niwache. Nione ni watu wangapi wako class kwanza. Mko wengi Nikiona watu wamerudi chini, mimi namaliza class. Inaona bado mko. Okay. So we want to observe what happens. We want to justify the proposition of the theory. What happens if the company increases the amount of debt in the firm's capital structure? Currently, you can see this firm has in issue a 5% debenture that was raised to was issued to raise 5 million shillings. But suppose this firm were to acquire, increase the amount of debt to 10 million and increase it to 15 million. What happens? So we have debt, current debt of 5 million. I'm answering these questions at the same time. So the amount of debt is 5 million. It can be increased to 10 million and it can be increased to 15 million. We want to observe what happens if a company were to increase the amount of debt. Now, whether the amount of debt is 5 million or 10 million or 15 million, we're informed that the operating income of the company does not change. If you check this question, says, ABC Limited generates operating income of 6 million each year. Whether debt is at 5, 10, or 15, the operating profit, you can see that is 5 million. 6 million, sorry. So irrespective of the amount of debt, operating income is constant each year. So we deduct interest. We are told debt is trading at par, meaning par value is equal to market value. So at 5 million debt, the coupon rate of this debt from the question you can see 5% venture. So if you take 5% of 5 million, does it give you 250? Can you go to your calculators and please confirm? 5% of 5 million? 5 million is the market value and is the par value because debt is trading at par.
Yes, 250.
250, yeah? So operating income minus interest, that is 6,000 minus 250. Do you find 5750?
Yes, 5750.
Now, if debt is increased to 10 million, no change in the coupon rate, so 5% of 10 million, that is 500,000, eh? Isn't it?
Yes.
So 6 million minus 500,000, is it 5.5 million? Operating income minus interest?
It's 5.5 million.
Okay, if the amount of debt in the firm's capital structure are increased to 15 million, how much interest is payable? No change in the coupon rate, so 5% of 15, is it 750?
750.
So how much is the net income?
5250.
That is operating income minus interest. Eh? Now, I want us to compute the current market value of equity. The current market value of equity shares is what I've defined as S. Eh? Sindio? Ama kuna wengine wamelala hapa kidogo eh? Wamesahau? Nione wale wamelala eh? Unfortunately, my videos zimezimwa, sasa sijui wale wamelala. Videos zimezimwa hapa sasa, watu wengine wanasikiza muziki hapo kando eh? Haya. So market value of equity is operating income minus interest divided by cost of equity. Sindio? Hii formula mmeikumbuka eh? Operating income minus interest over the cost of equity. Operating income minus at 5 million debt, DE of 5750, divided by cost of equity. We have assumed the cost of equity does not change. Cost of equity, ukiangalia kwa swali, ni ngapi? 10%. Eh? The cost of equity is 10%. And I said, cost of equity of a firm remains constant as the company increases the amount of debt in their capital structure. So cost of equity, your assumptions umeiona hapa juu. The cost of equity of a firm remains constant. Eh? So does not change. So you'll take 750 divided by 10. Hiyo inakupatia 57,250.
57,500.
250, eh? Kienda upande ingine.
Mwalimu, it's 57,500.
Oh, kuna error, eh? I need to go to my book and correct. Hii nitakumbuka kweli kwenda kuangalia. Nitaenda kwa hiyo kitabu yangu niangalie. Thank you so much for that. Eh? It's 57,500. Eh? Okay.
No, 750.
Oh, 750. Eh? 50.
Yeah.
57.
57,500.
500. Sorry, 500.
Iko sawa?
Yeah, it's okay.
Okay. If debt increases to 10 million, how much is operating income minus interest? 5,500. Eh? Divided by 10. Cost of equity does not change. Does it come to 55 million? The market value of equity?
Yes. Yes.
Yeah.
Debt ikipanda to 15 million. Operating income minus interest, 5250. divided by 10. Does it give you 52,500?
Yeah.
Yes.
Current market value of debt. Current market value of debt. Hiyo tulisema interest divided by KD. By the way, this working even we don't have to do it because the question is very clear. The question is very clear up here. Angalia hapa, tunaambiwa each unit of the debenture is currently trading at par. Each unit of the debenture is currently trading at par. That means the market value. Par value is the market value. So 5 million is the par value and is the market value. 10 million is the par value and the market value. 15 million is the par value and the market value. Okay, now start not with the standing. We don't have to compute here to tungeongeza to direct. But that notwithstanding, if you take interest divided by KD, interest at 5 million debt is 250. 250 divided by 5% KD, you inakupeleka 5 million. At 5 million debt, interest is 250 divided by KD, which is 5%. Takes you back to 5 million. At 10 million debt, interest is 500.
Yes.
Sasa hapa kuna error tena. I need to go and immediately after class and correct these errors. You need 500,
Yes.
500 divided by 5%.
10 million.
10 million, Na ukirudi upande ingine 750, Sasa hii 2250 nimetoa wapi hizi? Kuna errors kumbe na sikuwa naona. So 750 divided by 5%.
15,000.
Kuna na maera hapo na sikuwa nimeona. I think I need to go back to the book and make those corrections. 15, So how much is the total market value of the farm now? Total market value of the farm is market value of equity plus market value of debt. Market value of equity plus market value of debt. At 5 million debt, it is 57,500 plus 5,000. Does it give you 62,250?
62,500.
Oh, kuna shida. 500, If the amount of debt is increased to 10 million, you take 55, market value of equity plus market value of debt, 65 million.
Yes.
No pande ingine, 52,500 plus 15, 67,500.
Yes.
Yes.
What are you observing? What are you observing about the market value of the farm?
It's increasing.
It's increasing. I think that supports the proposition of the theory. That supports the proposition of the theory that as a farm increases the amount of debt in its capital structure, the market value of the farm increases. And you can see it is increasing. Let's see what happens to weighted average cost of capital at each of those levels of debt. You need to remember your computation of the weighted average cost of capital, ladies and gentlemen. Hiyo ni application of cost of capital as section 3 sasa. At 5 million debt, what becomes the weighted average cost of capital? I hope at the back of your mind you can see the formula. Cost of equity, hiyo ibadiliki. Cost of equity is 10% times market value weight of equity. Market value weight of equity at 5 million debt. Hiyo ni S divided by V. 57,500 divided by 62,500. What is the answer? 57,500 divided by 62,500.
0.92.
Oh, coincidentally, hiyo haiku affect kitu hapa. Iko sawa?
Yeah.
0.92, Cost of debt 5%. Cost of debt, hiyo mmeona KD is 5% times the market value weight of debt, 5,000 divided by 62,500. Inakuwa ngapi?
0.08.
So what is the company's weighted average cost of capital? Does it come to 9.6%?
Yes, 9.6%.
Weighted average cost of capital at 5 million debt. Eburudia at 10 million debt. Suppose now the amount of debt would increase to 10 million. Cost of equity no change, because the assumption is that cost of equity remains constant as a firm increases the amount of debt. That's what the net income theory assumes. Which is the market value weight of equity, 55,000 divided by 65,000? Does it give you 0.85?
0.85.
0.85.
Okay, cost of debt is 5% times market value weight of debt, 10 divided by 65,000.
0.15.
So what is the overall cost of capital? 9.3%.
9.25.
Roughly 9.
Yeah, if you round off.
9.25.
9.25 if you round off is 9.3%.
Okay. Can you work out now the weighted average cost of capital at 15 million debt? Can you confirm? At 15 million debt? Can you confirm at 15 million debt?
Weight is 0.78 and
8.9%.
0.22.
Confirm the final answer.
8.9%.
So the answer is correct. 8.9%.
Yeah.
Eh?
Yes,
Yeah.
8.9%.
So what is happening? As the amount of debt are increased in the firm's capital structure, what has happened to the overall cost of capital?
It's
Has come down.
decreasing.
Yeah, market value of the firm has increased, but the overall cost of capital has come down. Eh? Is this what the theory was saying? Look at the opening paragraph. What does it say? This capital structure relevance theory that provides that a capital structure decision is relevant, and therefore a capital structure change will have an effect on both value of the firm and weighted average cost of capital. Look at the second paragraph. The theory argues that as the firm increases the amount of debt in its capital structure, current value of the firm increases and its weighted average cost of capital reduces. Is that what we have confirmed?
Yes.
However,
Yes.
the increase in the amount of debt in the capital structure should occur up to the optimal gearing point. This implies that if debt is increased beyond this point, the firm value begins to fall and its weighted average cost of capital increases. The theory. So I think that is what we have confirmed. We have been able to confirm the proposition of the theory. Now, the other theory, I want to talk about these two theories only. Okay? The net operating income theory. Now, that is a capital structure irrelevance theory. Unlike the net income theory, which is a capital structure relevance theory, is a capital structure irrelevance. I think I can give 5 minutes break. Can I?
Sure. Yes. Thank you.
Let me give you 5 minutes break. Eh? Nikikaa sana munipigie simu. Naweza to begin a class at 9:30. 9:30 I was asleep. Sijui nilala aje leo sana. Kama ni mwili hajapata nguvu kabisa. 9:30 I was asleep. supposed to be starting a class at 9:30 na usingizi nimenishika kweli kweli. go through this theory, please. Let's go through this theory so that we finish. The net operating income theory. Can we move on?
Yes.
Now,
Yeah.
net operating income theory is a capital structure irrelevance theory. And I've already said that when we say capital structure irrelevance, what it means is that a capital structure change will have no effect on value of the farm and will have no effect on the farm's weighted average cost of capital. It's a capital structure irrelevance theory. Even if a company were to increase the amount of debt in the farm's capital structure, even if a farm were to increase the amount of debt in the farm's capital structure, the value of the farm will remain constant and weighted average cost of capital will remain constant. That means a capital structure change is not expected to have an effect on value of the farm and is not expected to have an effect on the farm's overall cost of capital. But there are two issues that we have to take note. One is that the computation of value of the farm changes. Formula for establishing the value of the farm changes. You can see here, I'm saying that using the net operating income approach, the current market value of the farm is determined on the basis of discounting. On the basis of discounting the farm's, on the basis of discounting the farm's future operating income. Please, that's a very, very important sentence. The current market value of the farm is determined on the basis of discounting the farm's future operating income using weighted average cost of capital as a discounting rate. Let's not forget, we have already said that one of the assumptions of this theory, these theories, is that operating income each year is known and remains constant. So that operating income is a perpetual annuity and therefore discounted at the weighted average cost of capital of the farm. Unlike the net income theory, where we were saying V is equal to S plus B, the formula for computing value of the farm changes in this case. Let me go back to this board so that I can clarify that picture. Now, under the net income theory, we said V is equal to S plus B. This applies to net income theory. When we come to net operating income theory, V is equal to operating income, which is assumed to remain constant each year in perpetuity times 1 over discounting, where the discounting rate is the weighted average cost of capital of the farm. We are discounting a perpetual annuity. So in this case, you take the operating income. And remember, it's not operating income minus interest. It's simply operating income times 1 over the overall cost of capital. Once you have established V, then now we can look for the market value of equity, which is V minus B. The market value of equity is residual. You begin by looking for the market value of the farm by discounting. And remember, I've already said V does not change anyway. Whether the amount of debt is 5 or 10 or 15, V remains constant. Now, that V, remove the amount of debt, which can vary, should give us the market value of equity. So I think that should be very, very important. That's the point I was making here, that using the net operating income approach, the current market value of the farm is determined on the basis of discounting the farm's future operating income using weighted average cost of capital as a discounting rate. This means market value of equity is residual. I think I've clarified that. Using the net income theory, unlike the net income theory where cost of equity of a farm remains constant as a farm increases the amount of debt in capital structure, you saw that. The cost of equity does not remain constant under the net operating income theory, but instead the cost of equity will increase with the increase in debt in the capital structure. This makes sense because equity holders need to be compensated for the risk exposure. Yeah, I think that makes more sense because if you increase the amount of debt in the farm's capital structure, then we expect ideally that your risk exposure is higher and therefore you require compensation in terms of demanding a higher minimum required rate of return. Quickly, I want to look at this more illustration and I request that you guys take a break. Endelee kusoma subjects zingine. So please be reading this that illustration. So this question reads, XYZ Limited generates operating income of 5 million each year. This is expected to remain constant each year in perpetuity. The firm's overall cost of capital is 20%, weighted average cost of capital. The firm issued 10% debenture to raise 5 million shillings. Each unit of debenture is current trading at par. There are no taxes required. One, the current value of the firm. Two, recompute the current value of the firm, cost of equity, and the firm's weighted average cost of capital if the amount of debt in the firm's capital structure were to increase to 8 million and were to increase to 12 million. What is your observation? Okay, so you can see the amount of debt. Currently, the amount of debt is 5 million, which can increase to 8 million and increase to 12 million. So the amount of debt, 5 million, which can increase to 8 million and then subsequently could increase to 8 million. I want to see what happens. I've done some working here. The operating income is 5 million. I think you have seen in the question. XYZ Limited generates operating income of 5 million each year. So 5 million year one, 5 million. If the debt is 5 million, operating income does not change. Even if it were to raise to 8 million, that is still 5 million. If it were to increase to 12 million, you see, does not change. Less interest. So if you look at the question, the rate is 10%. The firm issued a 10% debenture. So the coupon rate is 10%. 10% of 5 million is how much? Interest payable at 5 million debt. That is 10% of 5 million, which is 500. So operating income minus interest should be 4.5 million. Then if amount of debt were increased to 8 million, so if you take 10% of 8 million, that should be 800,000 interest. So 5,000 minus 800,000, operating income minus interest is 4.2 million. Of course, that's a net income because we don't expect taxes to be paid. At 12 million debt, operating income is 5 million minus interest, 10% of the 12 million, that is 1.2 million. 3.8. That's a working I've just done there. Then current market value of the firm. Remember, under the net operating income theory, V is operating income discounted at the firm's overall cost of capital. Now, in this question, we know the firm's overall cost of capital, 20%. So if you take operating income of 5 million, remember, you don't remove interest. It's operating income divided by the overall cost of capital. So that is 5 million divided by 20%, that is 25 million. And remember, no change in operating income, no change in the firm's overall cost of capital. And that trend, therefore, even if debt were to increase to 8 million, value of the firm does not change, still remains at 25 million. Even if the amount of debt were to increase to 12 million, the value of the firm still remains at 25 million. The reason is because the firm's operating income is not expected to change, and the firm's overall cost of capital is not expected to change. Therefore, V remains constant. Now, current market value of equity, S is equal to V minus B. So if you check at the first level of debt, which is 5 million, we know the market value of the farm is 25 minus the amount of debt, which is 5 million. That means the market value of equity will be 20 million. Under 5 million debt, the market value of equity is 5 million. Under 8 million debt, the market value of equity is 17 million. 25 million minus 8 million, that is 17 million. When the amount of debt is increased to 12 million, when the amount of debt is increased to 12 million, then you take the value of the farm, 25 million minus 12, which is 13 million. Equity is residual. Now, the cost of equity at each level of debt is what I've worked out. At shillings 5 million debt, now you have to remember our formula. Cost of equity is operating income minus interest divided by the market value of equity. Operating income minus interest in the first level of debt, 5 million debt, in the year due, we worked it out, that is 4.5 million, divided by market value of equity, which we have established here, 20 million times 100. Cost of equity at 5 million debt is 22.5%. At shillings 8 million debt, operating income minus interest, we had worked it out here, up here, had done our working earlier, that is 4.2 million, divided by the market value of equity, which is residual, 17 million times 100, that is 24.71%. Cost of equity at 5 million, at 8 million debt. At 12 million debt, operating income minus interest, we have already done our working also. I think is here, 3.8 million. 3.8 million divided by the market value of equity. We have done our working here, 13 million times 100. It becomes 29. Becomes 29.24%. So at 12 million debt, the cost of equity is 29.24%. Now we can work out the weighted average cost of capital at each level of debt. So at 5 million debt, weighted average cost of capital, cost of equity, I've just worked it out, times market value of equity, market value weight of equity. You remember equity was residual of 20 million divided by the value of the farm. Cost of debt is 10%. Debt is 5 million divided by the value of the farm. And the weighted average cost of capital should be 20%. Maybe if you can confirm. Under 5 million debt. So I've simply said cost of equity times S over V. Market value weight of equity plus cost of debt times B over V. Market value weight of debt. That, is it 20%?
Yes.
Okay.
Yes, 20%.
If the amount of debt is increased to 80 million, we recompute again the overall cost of capital. At 8 million cost of equity, I've already worked it out here. Here 24.71%. So cost of equity is 24.71%. The amount of debt, equity, remember, was residual. Equity is residual. 25 million minus 8 is 17. So the market value weight of equity 17 over 25 plus 10 times 8 divided by 25. The weighted average cost of capital is 20% again. If you can confirm.
It's 20.
20%. What would you confirm? That's 12 billion debt. Can you confirm the answer? The overall cost of capital at 12 billion debt.
Yes, 20%.
20%, eh? So what are we observing? No change in the overall cost of capital. Remains at 20%.
Mhm.
No change in the value of the farm. Value of the farm remains 25 million, even if the amount of debt were to increase. You can see it here. Value of the farm remains constant at 25 million. The overall cost of capital remains constant at 20%. Therefore, what are we observing? The increased amount of debt in the farm's capital structure has no effect on the current value of the farm and no effect on the farm's overall cost of. Therefore, capital structure decision is irrelevant. So I think we've been able to justify the propositions of those two theories, so that next week we'll embark on Modiglian and Miller's propositions, MEM 1, MEM 2, the MEM 3, and the MEM 4.